Paul Rawkins is Senior Director at Fitch Ratings. I'm pleased to say he joins me in the studio now. Paul, thanks so much for coming in. So tell me a little bit more about the reasons behind Portugal's downgrade.
Chiefly a response to the collapse of the government and what it means for the fiscal consolidation programme, which is now in doubt. And as a result of that, in our view, it greatly limits their access to the markets and makes an approach to the IMF EU virtually inevitable, really.
Virtually inevitable. What sort of timescale could we be looking at?
I think it's not immediate in the sense, in our view, Portugal can still get through the April bond issuance, but clearly after that, June looms into place, and we don't want to get into a situation where we did with Greece, where we don't get any sense of clarity until the very last minute, because that's the worst thing that could happen, really.
So, from what you're saying, a bailout is almost inevitable. What do you make of what we're seeing in the markets right now? Yields, we've already seen yields rise to a record high. Is that likely to continue, not just with Portugal, but also Ireland?
I think it is probably because when you look at these other programmes in Ireland and Greece, it hasn't delivered the desired effect, in the sense rates have not come down, and it's a sense really that. The way the market reads it, I think, is it thinks the EU is just deferring the problem, really. It's just pushing it down the road, and it will get addressed in 2013, and that raises all sorts of new concerns about restructuring, all those things.
OK, so what about Spain then? 30 banks have been downgraded. Should we be more concerned about the situation in that country, given that bank debt levels are a lot higher?
I think with Spain we see definite decoupling, really. I mean, interest rates have not moved in the same way. But what is also true of Spain, I think Spain has moved to address the problems that it has in the banks and on the fiscal side, on the structural side. There's been a lot more action, really, than there was in Portugal. And I think the Spanish have been much better at conveying that message to investors.
Because when we look at these fragile economies in Europe, they are often lumped into one category. You know, we speak about Greece, Portugal, Spain, Ireland, Italy, but actually you're saying that we need to make a distinction, not just in economic terms, but also with regards to what we're seeing in the markets between the likes of Portugal and then Spain.
Yeah, and I think there has been, I mean, clearly the line in the sand is drawn at Spain, there's no doubt about that, but I think there is some recognition that actually that Spain has moved faster and more deeply than the others.
And also on the agenda of the leaders' meeting currently taking place in Brussels, the possibility of lower interest rates for Ireland's emergency loans. How important do you see that as being to?
No, well, it clearly would be helpful to Ireland because their debt is also heading off into 120% GDP. So it would be a credit-friendly move. But they have to. I think they will be required to make concessions in order to win that concession.
Yeah. OK, well, great to talk to you. Thanks so much. Paul Rawkins, Senior Director of Fitch.